Hello friends, my name is Amit Kachilia. Now, my NGO, Finlight Foundation, that is Financial Literacy Foundation, with the sole motto to create a wave of financial literacy amongst public at large. We take free seminar sessions in various corporates, and apart from this, we are starting this YouTube series with the sole motto of creating financial literacy amongst public at large. We are wanting that people should follow this mantra called as do it yourself. Apart from that, the other motto of this series being financial planning is a universal concept, so any citizen of any country can use these concepts for their own benefit. And of course, no country can have a sustained economic development unless and until their middle class families are financially independent. Whatever opinions and views we are giving, those are very much unbiased, because neither myself, neither my company, neither my NGO or any of my employees are associated to any financial product selling company. So our views are to that extent very much unbiased. Whatever detailing is required, customization is required, because our videos will be broadly generalized in nature, but we'll try to catch up with the customization at a later stage of our videos. Yeah, topic remaining the same, importance of financial planning in an individual's life. Recap. The broader aspects of financial planning which needs to be covered by the family person are insurance planning, investment planning, tax planning, retirement planning and estate planning. Today in this video, what we are covering is insurance planning. Why a family needs insurance? Why I need insurance planning? A very famous quote: husbands rarely believe in life insurance, but widows always do. Okay. Now, see, needing insurance is like needing a parachute. If you do not need it for the first time, don't worry, you won't require it for the second time. Now, what I have done is, we have divided insurance into broadly 3 areas which a family needs to consider. We are dividing a human life. See, this slide is very important from all videos perspective, the whole financial planning perspective. If a person does all this, he has done his financial planning. A scenario of the family could be all is well. Second scenario could be a disease occurs to the family person, disability or death. These are the 3 negative things: disease, disability and death, the 3 Ds. If all is well, still what he has to do? He has to stick to his discipline. Please do check out my earlier videos. Goal-based financial planning, goal-based investment planning. So he has to stick to his discipline, save money, invest considering the goals and grow the money to achieve those goals. Okay, goal-based. What if disease happens to the family person? He should have medical cover, mediclaim cover. Apart from that, he should have a critical illness cover. We will be having a separate video only on critical illness cover. Then, next being disability cover. Okay, I suffered from disease, that's fine. My hospital cost got reimbursed from the insurance company. What if I get disabled? Let's say my hands are being cut in the accident or so on. This policy, called as personal accident policy, will help me to support my family till I reinstate myself physically. What if death occurs to me? I need to have only this cover called as pure term policy. No other life insurance product is worthy enough than this. So, death happens, my family still be able to achieve all the financial goals which I set for my family through this sum assured received from this company, insurance company, under pure term. If in a road there is a small gap or a cutout, okay, a pothole, PA policy or a critical illness, nothing but that. It will kind to bridge that particular gap. Now, how much insurance covers? So now let me focus only on the life insurance aspect, the life insurance pure term policy. How much should be my sum assured? Too huge doesn't make sense. Too small doesn't make sense. A cover covering my family. Now, what again a common mistake people do? They go for a thumb rule formula. Like, let's say my income is 10 lakhs, rupees 10 lakhs. Somebody may say, okay, Amit, you apply thumb rule of 15 times of your income. So 10 lakhs into 15, 1 crore 50 lakhs. Buy it. Now if I apply, now let us understand why these thumb rules are going wrong. Let's take Amit A, Amit B. Okay, so family A, family B. Both families' income are same, 10 lakhs, 10 lakhs. Fine. Both having one wife, one child, one child. But the goals may be different. Like child of Amit A may be going in some state public school. The child of family B may be going in some international school, international school like ICSE and so on. So now the expenditures are different. So how can both the families have same cover? So a family needs to apply a concept called as human life value. Now what does that mean? I am a cash cow for my family till I am minting money for my family. See, this is very harsh. But as I said, think it from your left brain, the logic brain, not the emotional brain. So I need to give an intrinsic value, present value to my income. How much I would have, currently my age is 40. What is the income I will be generating for my, let's say next 60 years? It's of course a scientific and mathematical formula to be applied. I'm not going to that details of it right now. So let's say a price tag is attached to me. So today's price tag is, let's say my Amit's price tag of today is, let's say 5 crore. This is just an example. So 5 crore. This is the way it's calculated is that in my absence, that is in case of my death, by whatever means, my family's all financial goals are achieved. So they are not compromising on their goals. They are not compromising on their standard of living. So thumb rules are of no use. Human life value, mark my words. This is a concept framed by somebody else, Mr. Hubner. It's a very logical concept. Now, let's compare which cover, from whom. So, buy from online option. Reason being, there is no middleman. So, the commission is being saved by you. So, to that extent, your premium gets reduced. So, this is a comparison of an online private insurer. I cannot name anybody. And some public insurer of India. See the difference of premium. Private insurer for a cover of 50 lakhs. Age 35 of the participant, the life assured. Age 35, cover of 25 years. So, till his age of 60. Cover 50 lakhs. How this cover needs to be calculated? Human life value concept. Then, premium is coming out annually because this is a pure term policy. If death happens, then only the family gets the cover money. If that doesn't happen, the family doesn't get anything. Okay, so that's why it's called as pure term policy. For a private insurer, the premium is hardly 6,500. For a public insurer, it's very much huge. The reason being the commission cost. So the total saving the family can make in 25 years in this example is 2.5 lakhs. A penny saved is penny earned. Claim settlement. Again, please, I'm not saying that this company is better than the other. This is just a data being publicly shared by IRDA, Insurance Regulatory Development Authority of India. LIC, 97% claim settlements out of 100 claims, 97 have been settled. So HDFC or ICICI are not back, not so much back in when it comes to claim settlement. See, even some of my subscribers may be working in some private companies. And see, if you're working in a private company, then why to worry about a private company? Claim will be settled because everybody is governed by the solvency norms of IRDA. Why start taking insurance cover early? Because the earlier your age, the lesser is your premium. And that premium gets locked for the rest of the tenure. This is the benefit of life insurance pure term. That is of course not the case with a critical illness cover or a Mediclaim. That may keep on rising based on various blocks of years. But in case of life insurance, the earlier age, the lesser the premium. Let's take this example. 25 years of age, cover of 35 years. Annual premium for 50 lakhs is hardly 4,750. So, for 35 years, total is paying how much? 1,66,000. a bit late in taking the cover. So he's losing 10 years. So he already taken 10 years of risk of death. Hardly 6,000 of difference and so on. Yeah, some principles to follow, because as I said, you can go for online. First, follow the principle of utmost good faith. That is uberima fidai. That is, whatever you say, it is under oath. Okay. So, for example, if you are smoking, mention that. If you are drinking, mention that, and so on. Then, fill up the application form. Let's say you received your policy document at your doorstep. You still have 15 days to cancel. It's called as free look-in period. You are still allowed to cancel your contract. Company will refund your premium amount, barring some charges. And please buy insurance as an insurance and not as a tax saving instrument. Yeah, tax saving is an additional feature, additional benefit given to you. But buy insurance as insurance. Don't treat it as an investment product. Don't treat it as if I am giving money to insurance company, what I am getting back. For that particular thinking psychology, there are many other investment products giving you better rate of return. So don't buy as such any traditional or endowment plan. That is not making any sense. Please do subscribe to my YouTube channel and do hit the bell shape icon. And of course, enable the YouTube notifications in your smartphone to watch the same videos on your smartphone also. And happy financial planning, and watch out for my next video. Thank you.